It's December 20th, 1994. Mexican families are preparing for Christmas when suddenly, their money becomes worth half of what it was just days before. Imagine waking up and finding out that your $10,000 in savings is now worth $5,000. That's exactly what happened to millions of Mexicans during what would become known as the Tequila Crisis. In just 3 months, Mexico went from being Wall Street's golden child to needing the largest financial bailout in history at that time, a staggering $50 billion rescue package. The peso lost 50% of its value in weeks. Interest rates shot up to 80%. And here's the kicker. This wasn't just Mexico's problem. The crisis nearly took down the entire U.S. banking system and introduced the world to a terrifying new phrase: emerging market contagion. Today, we're diving into the economic disaster that most Americans slept through, even though it almost crashed their own economy. We'll uncover how a country that was supposed to be the model for developing nations nearly defaulted on its debt, why the Clinton administration scrambled to assemble the biggest bailout ever seen, and how this crisis forever changed the way the world thinks about global financial risk. If you want to understand the economic events that shaped our modern financial system while most people weren't paying attention, make sure to hit that like button and subscribe to the channel. Chapter 1: Mexico's Miracle Economy. To understand how Mexico's economy collapsed so spectacularly, we need to go back to the early 1990s. Mexico was the poster child for economic reform. After decades of closed markets and government control, Mexico had embraced free trade, privatized state companies, and opened its doors to foreign investment. Think of it like a restaurant that had only served locals suddenly putting up a sign saying, "International visitors welcome." And the world was hungry. President Carlos Salinas, who took office in 1988, was transforming Mexico into what investment banks called the next economic miracle. He slashed government spending, sold off hundreds of state-owned companies, everything from airlines to telephone companies, and most importantly, he was negotiating NAFTA, the North American Free Trade Agreement with the United States and Canada. Wall Street was in love. Foreign investment poured into Mexico like water through a broken dam. In 1993 alone, foreign investors pumped $30 billion into the Mexican economy. That's more money than Mexico had received in the entire previous decade. American mutual funds were telling their clients that Mexico was the future. Pension funds were buying Mexican government bonds paying 15% interest when U.S. bonds were paying just 5%. It seemed too good to be true. And it was. But here's what most investors didn't see. Mexico was financing this boom with something called Peso bonos, government bonds that had to be paid back in dollars, not pesos. It's like taking out a loan in a foreign currency to renovate your house. Great if your income stays stable, catastrophic if it doesn't. By 1994, Mexico had issued $29 billion worth of these dollar-linked bonds. The Mexican government was also doing something clever but dangerous with the peso. They kept it artificially strong against the dollar using what's called a currency peg. Imagine if you owned a store and promised customers that your store credit would always be worth exactly $1 no matter what. To keep that promise, you'd need a lot of actual dollars in your safe. Mexico was making that same promise with the peso, but their safe, their foreign currency reserves, was getting dangerously empty. Meanwhile, Mexico's trade deficit was exploding. Mexicans were buying imported goods like crazy because the strong peso made foreign products cheap. In 1994, Mexico was importing $18 billion more than it was exporting. Money was flowing out faster than it was coming in, like a bathtub with the drain open and the faucet barely trickling. Chapter 2: Warning Signs and Political Chaos. This brings us to 1994, the year everything started to unravel. It began with what seemed like an isolated incident. On January 1st, the same day NAFTA went into effect, an armed rebellion broke out in Chiapas, Mexico's poorest state. The Zapatista uprising, as it was called, shocked investors. Suddenly, Mexico didn't look as stable as everyone thought. But that was just the appetizer for the chaos that would follow. On March 23rd, Luis Donaldo Colosio, the ruling party's presidential candidate, and Salinas' hand-picked successor, was assassinated at a campaign rally in Tijuana. The gunman shot him in the head at point-blank range in front of thousands of supporters. Mexico hadn't seen political violence like this in decades. The assassination sent shockwaves through the financial markets. Foreign investors started asking uncomfortable questions. Was Mexico really as stable as they'd been told? Was their money safe? Some investors began quietly pulling their money out. Mexico's foreign reserves, which had been $30 billion in February, started dropping. Think of it like a bank where people start withdrawing their deposits. Not a full run on the bank yet, but enough to make the managers nervous. The Mexican government tried to calm fears. They raised interest rates to keep investors from leaving, offering even higher returns on those Peso bonos. It's like a store offering bigger and bigger discounts to keep customers from shopping elsewhere. But here's where it gets interesting. Instead of being transparent about the problem, Mexican officials kept insisting everything was fine. In August 1994, Mexico held its presidential election. Ernesto Zedillo, the replacement candidate from the ruling PRI party, won. But instead of calming markets, this created more uncertainty. Zedillo was an economist, not a politician. Nobody knew what he would do once he took office in December. Behind closed doors, Mexican financial officials were panicking. By November 1994, foreign reserves had fallen to just $12.5 billion. Remember those $29 billion in Peso bonos that had to be paid back in dollars? Mexico was running out of dollars to pay them with. It's like promising to pay your mortgage in gold when your gold supply is running out. The situation was made worse by something happening 2,000 miles away in Washington. The U.S. Federal Reserve had been raising interest rates throughout 1994 to prevent inflation. When U.S. interest rates go up, investors can make good returns on safe U.S. bonds. Why risk money in Mexico for 15% when you could get 7% in super safe U.S. Treasury bonds? Money started flowing out of Mexico even faster, like water seeking its level. By early December 1994, Mexico's foreign reserves had dropped to just $10 billion. Government officials faced an impossible choice: devalue the peso and admit they'd been lying about the economy's strength, or keep burning through reserves until they ran out completely. On December 19th, they chose door number 1, sort of. Chapter 3. The Peso Collapses. December 19th, 1994 started like any other Monday in Mexico City's financial district. But in a closed-door meeting that morning, the new finance minister, Jaime Sarapuche, was telling a group of Mexican businessmen something that would trigger an economic earthquake. The government was going to devalue the peso by 15%. Now, a 15% devaluation sounds manageable. If you had 100 pesos worth $30 on Monday, by Tuesday it would be worth $25.50. Not great, but not catastrophic. The government thought they could control it, like letting a little air out of an overinflated balloon. But they miscalculated badly. The businessmen in that room didn't wait. They immediately started calling their brokers, converting every peso they had into dollars. Word spread through Mexico City's financial district like wildfire. By noon, everyone with money was trying to convert pesos to dollars. The controlled 15% devaluation turned into a stampede. Foreign investors were furious. They'd been assured for months that the peso was stable. Now they realized Mexican officials had been lying. Trust, once broken in financial markets, is almost impossible to rebuild. Investors didn't just want out of Mexican pesos. They wanted out of Mexico entirely. On December 20th, the Mexican government abandoned the currency peg entirely. The peso went into free fall. It's like removing the supports from a damaged building. It doesn't fall slowly, it collapses. Within days, the peso lost 30% of its value. By the end of December, it was down 50%. Here's what this meant in real terms. A Mexican company that had borrowed $1 million when the peso was at 3.5 to the dollar now owed 7 pesos for every dollar. Their debt had just doubled in peso terms. Thousands of Mexican businesses that had borrowed in dollars were suddenly bankrupt. But the real panic was in New York and Washington. U.S. banks had loaned $25 billion to Mexican companies. Mutual funds held billions in Mexican bonds. The Texas banking system, still recovering from the savings and loan crisis, had huge exposure to Mexico. If Mexico defaulted, some of America's biggest banks could fail. The term tequila effect was born as the crisis spread to other emerging markets. Investors pulled money out of Argentina, Brazil, Thailand, any country that looked remotely like Mexico. It didn't matter that Argentina's economy was different from Mexico's. Panic doesn't do nuance. This was the world's first taste of emerging market contagion, the financial equivalent of a virus jumping from country to country. On January 2, 1995, Mexico's new president Zedillo had been in office for exactly 1 month. His country was in economic freefall. Interest rates hit 80% as the government desperately tried to stop capital flight. Inflation was exploding. Mexican companies were going bankrupt by the hundreds, and Mexico had just weeks before it would default on its debt. Chapter 4. The biggest bailout in history. President Clinton's economic team watched the Mexican collapse with growing alarm. Robert Rubin, the new Treasury Secretary and former Goldman Sachs executive, understood that Mexico's crisis could trigger a global financial meltdown. If Mexico defaulted, U.S. banks could lose $25 billion overnight. The damage could spread to other emerging markets, then to Europe, then back to the United States like a financial boomerang. On January 12, 1995, Clinton announced a $40 billion loan guarantee package for Mexico. But here's where it gets complicated. He needed Congress to approve it, and Congress, especially Republicans who had just taken control after the 1994 midterm elections, wanted nothing to do with bailing out Mexico. Senator Alphonse D'Amato called it a ripoff of the American taxpayer. Why should American tax dollars rescue Mexican politicians who had mismanaged their economy? As Congress debated, Mexico's situation grew more desperate. The peso kept falling. Mexican banks were failing. There were rumors of food shortages. Clinton's team realized they couldn't wait for Congress. They needed to act immediately, or watch America's third-largest trading partner collapse. Robert Rubin found a solution that was clever, controversial, and probably illegal. He used something called the Exchange Stabilization Fund, a Depression-era tool meant to protect the U.S. dollar, to bypass Congress entirely. On January 31, 1995, Clinton announced a new rescue package, $20 billion from the U.S., $17.8 billion from the International Monetary Fund, $10 billion from European governments, and $3 billion from commercial banks. Total, $50 billion, the largest financial bailout in history at that time. But this money came with brutal conditions. Mexico had to raise interest rates even higher, cut government spending, and basically put its economy into a medically induced coma to stop the bleeding. The IMF took control of Mexico's oil revenues as collateral. Imagine having to hand over your paycheck to your creditor before you even see it. That's what Mexico had to do with its oil money. The bailout worked, barely. The peso stabilized around 7.5 to the dollar. Foreign investors slowly started returning, but the cost to ordinary Mexicans was devastating. The economy contracted by 6.2% in 1995, the worst recession since the 1930s. Unemployment doubled. 2 million Mexicans fell into poverty. Banks foreclosed on homes and businesses. The Mexican middle class, built up over a generation, was decimated in months. In the United States, the political backlash was fierce. Republicans accused Clinton of bailing out Wall Street banks that had made bad bets on Mexico. Democrats worried about job losses as Mexican goods became cheaper and more competitive. The bailout contributed to the anti-globalization movement that would explode in Seattle 4 years later. Chapter 5. Lessons learned and ignored. Mexico paid back the U.S. loan by 1997, 3 years early, and the U.S. actually made a $500 million profit on the deal. By 1996, Mexico's economy was growing again. Foreign investment returned, though more cautiously. The crisis seemed to be over, but the real impacts were just beginning to be understood. First, the Tequila Crisis fundamentally changed how emerging markets operate. Countries learned they needed massive foreign currency reserves as insurance. Think of it like keeping a huge emergency fund after your house almost burned down. China, learning from Mexico's mistake, built up over $3 trillion in reserves. Countries also became wary of currency pegs and hot money, short-term foreign investment that could leave as quickly as it arrived. Wall Street learned different lessons. Investment banks created new financial instruments to bet against emerging market currencies. They developed credit default swaps, basically insurance policies that pay out if a country defaults. These tools would later play a starring role in the 2008 financial crisis. The Tequila Crisis didn't make the financial system safer. It made speculation more sophisticated. The crisis also accelerated changes in Mexico itself. The PRI party, which had ruled Mexico for 70 years, lost its monopoly on power. The peso crisis destroyed their reputation for economic competence. In 2000, Vicente Fox became Mexico's first non-PRI president, ending one of the world's longest-running political dynasties. But here's what's really fascinating. Many of the vulnerabilities exposed by the Tequila Crisis were never fixed. Countries still borrow in foreign currencies. Investors still chase high returns in risky markets. Governments still hide bad news until it's too late. The same pattern would repeat in Asia in 1997, Russia in 1998, Argentina in 2001, and arguably in the U.S. itself in 2008. The Tequila Crisis also transformed the relationship between the U.S. and Mexico. NAFTA had promised partnership and prosperity. Instead, its first year brought crisis and bailout. Immigration from Mexico to the U.S. surged as Mexicans fled the economic devastation. The crisis poisoned political discussions about free trade for decades. When politicians today argue about trade deals and immigration, they're still fighting about the Tequila Crisis, whether they know it or not. Most importantly, the crisis introduced the concept of moral hazard to international finance. By bailing out Mexico, and by extension the investors who had made bad bets, did the U.S. encourage even riskier behavior? If investors know they'll be rescued, why be careful? This question would return with a vengeance during the 2008 financial crisis, when too big to fail became part of our vocabulary. Chapter 6. What this means for you today. So what can regular people learn from a crisis that happened 30 years ago in Mexico? More than you might think. The Tequila Crisis offers timeless lessons about money, risk, and the interconnected world we live in. First, currency risk is real, and it's everywhere. Today, millions of Americans work for companies that do business internationally. Your 401k probably includes international funds. That vacation to Europe you're planning? Currency fluctuations could make it 20% more expensive by the time you go. The Tequila Crisis showed that currencies can collapse suddenly and without warning. Diversification isn't just about owning different stocks. It's about understanding what currencies your wealth is exposed to. Second, when everyone's excited about an investment, that's exactly when you should be careful. In 1994, Mexico was the hot investment that couldn't lose. Until it did. We've seen this pattern repeat with tech stocks in 2000, housing in 2008, and crypto in 2022. When taxi drivers and hairdressers are giving you investment tips about the next big thing, remember Mexico in 1994. Third, government promises about economic stability should be taken with a grain of salt, or maybe a shot of tequila. Mexican officials insisted everything was fine right up until the peso collapsed. American officials said subprime mortgages were contained in 2007. Chinese officials say their property market is stable today. Governments have political incentives to hide problems until they can't. Don't bet your financial future on official reassurances. Fourth, globalization means that a crisis anywhere can become a crisis everywhere. In 1994, most Americans had never heard of tesobonos or currency pegs, but Mexico's problems nearly crashed U.S. banks and definitely affected U.S. workers. Today, we're even more connected. A debt crisis in Italy could affect your mortgage rate. A bank failure in Switzerland could impact your job. Understanding international economics isn't optional anymore. It's essential. Finally, the Tequila Crisis teaches us that financial crises follow patterns. There's always a boom fueled by easy money and over-optimism. Warning signs are often ignored. Then comes a trigger event that exposes the underlying problems. Panic spreads. Governments intervene. Regular people pay the price. Understanding this pattern can help you protect yourself when you see it developing again, and you will see it again. The most practical lesson? Build your own reserves. Individuals rarely get bailouts. Having an emergency fund, avoiding debt in foreign currencies or variable rates you can't control, and being skeptical of investment fads could save you from your own personal peso crisis. If stories like this fascinate you, hit subscribe and the bell icon, because we're just getting started with these financial mysteries.